Ever wonder how the stock market actually works? It's not as complicated as you think. What are stocks? Imagine a company like a lemonade stand or a tech startup. When it wants to grow, it sells tiny pieces of itself called stocks to the public. Think of it like cutting a pie into slices. Each slice represents a tiny ownership piece of that company. And when you buy a stock, you're buying one of those slices, making you a part owner of that company. But wait, there are thousands of companies out there. How do buyers and sellers connect and trade these slices fairly? That's where the stock market comes in. The stock market is like a giant digital marketplace, or exchange, kind of like a simplified version of the NASDAQ or the New York Stock Exchange. It's a place where buyers and sellers can come together and trade these tiny ownership slices of companies, also known as stocks. So how does the price of a stock go up and down? Let's say you own a stock in a company. If the company does well, more people will want to buy that company's stock because they believe it will grow even more. This increased demand pushes the price of the stock up. But if the company isn't doing so well, people might sell their stocks, which can lower the price. So the stock market is like a giant digital marketplace where people can buy and sell tiny pieces of ownership in public companies. How do investors make money on the stock market? There are two main ways. First, investors can sell their stocks for more than they bought them for. Say you bought a stock for $10 and sold it for $20. You made a $10 profit. Second, some companies share their profits with shareholders through what are called dividends. Think of it like getting a little slice of the pie. So that's the stock market in a nutshell. It's a place where companies can raise money to grow and where everyday people, you can invest and potentially grow their money over time. Ready to learn more about investing? Check out our website for more tips and resources.
Thanks for watching.